In this video, I'm going to discuss whether it's a good idea for you to sell your bond fund or your bond index fund and move into a money market based on the big losses that bond funds and bond index funds had last year in 2022. Welcome back. This is episode 160. In this episode, I'm going to address a listener question that I've received a few times, and that question is, should they sell their bond mutual funds due to the large recent decline and move that money instead into money market funds that are more stable and potentially offering a higher yield? And as a reminder, if you have a listener question that you want to have considered, you can go to retirewithryan.com and click on Ask a Question. And from there, you can record your question. And if you'd like to have it featured on the episode, we can play that audio. Or if you're a little shy, no worries. You can type out your question and we can consider it for a future episode. And for those of you that are listening to this and not watching this on YouTube, as a reminder, I have a YouTube channel. And if you go to YouTube and search retirewithryan.com, you can see past podcast episodes as well as other videos, including even this episode where you can see some of the charts that I'm going to reference. And once you go there, if you could do me a big favor and you could subscribe to the YouTube channel, that way it'll help me continue to grow the podcast audience. So it's not surprising that I've received this question a few times, as 2022 was one of the worst years ever for bonds. In fact, the Barclays Aggregate Index, which tracks the bond market, lost roughly 13% last year. And that index was created in 1976, and this is one of the worst years ever, or is the worst year since its creation. The second worst year occurred in 1994. It was a negative 2%. Now, there are other indexes that track the bond market that you can get data on going back before 1976, but for this episode, that's as far back as I went. So here is the Barclays Aggregate Bond Index. I'll put a link to this. I found this chart showing the returns of the Barclays Aggregate Index, and we have here that since 1976 to 2002, it's averaged 6.9%. And again, the worst year occurred in 2022. And for the most part, if you look at these returns, you're not seeing a lot of negative returns. Now, one of the big headwinds that we've had in the past as interest rates were at a high point and they were cut. So that is a big headwind as far as why you see such high returns for the Barclays Aggregate Index in the 80s. And I'll come back to that in a little bit. Bonds are supposed to protect your money, and you may be wondering how this is possible for bonds to have such a large decline. And if you remember, just like stocks, bonds trade on a daily basis, and much of that change in price is dictated by interest rates. And bond prices and interest rates have what's known as an inverse or opposite relationship, meaning if interest rates go down, bond prices go up. And if interest rates go up, then bond prices go down. And that is exactly what happened in 2022. Interest rates went way up, causing these massive losses. And interest rates are controlled by our Federal Reserve, and they were raised a record 7 times in 2022. So if you're curious to all those raises, I found this chart on bankrate.com, and we can see, if I scroll down a little bit further here, we can see what all the rate hikes were that occurred in 2022. So again, there were 7 rate hikes that occurred. And the Federal Reserve gives a range as far as what they want the federal funds rate to be, which is the rate that they charge banks to borrow money, which kind of dictates what banks then lend people money. If you're borrowing money to buy a car or a house. And beginning in 2022, that range of rate was 0.25 to 0.50%, and it ended the year at 0.5 to 5.25. So that type of move is really catastrophic to long-term and intermediate-term bonds like those in the Barclays Aggregate Index. And if you were in a bond mutual fund, you might have lost a little bit more money or a little bit less. Just depends upon what the fund is invested in and how the fund manager did managing all these changes. But the odds are that you lost a considerable amount of money for a bond fund in 2022. So that begs the question, should you be getting out of your bond fund and going into a safer or more stable fund like a money market fund? And just like predicting where the stock market will go, the same can be said for predicting interest rates. Though it's believed by many, including myself, that interest rates would eventually need to go up to combat the massive amount of money that our government injected into our economy. The problem was that when was this going to happen, right? It was known for a while that rates would go up. The problem was when. And some might even say the Federal Reserve doesn't know where interest rates will go ever, as much of that movement is dependent upon the economic data that they use to measure and make a decision, measure the economic data and then make a decision as to where they need to go with interest rates. And just as I'm recording this, the Federal Reserve has raised interest rates another 1/4 percentage point, and many believe that this is the final rate hike by the Fed, and that next year in 2023, they will begin to lower rates. So if you were able to predict the movement of interest rates, you could make a lot of money in the bond market. And in an ideal world, you would have sold your bonds going into 2022, you could have moved into cash or money market, and you could have prevented yourself from any of these big losses that occurred in 2022. Now, back in the beginning of 2022, interest rate funds were paying very little money, so you wouldn't have made a whole lot of interest. You would start making more interest as the rates went up, but the big thing is you would have prevented those potential double-digit losses. Now, when interest rates begin to go down, you'd want to buy back into bond funds, especially long-term bonds, as those will go up the most in value when interest rates are cut. Now, I make this sound very easy, but it isn't. Many people on Wall Street's sole job is to trade bonds and to make money profiting from the trading of these bonds just based on interest rate movements alone. And as you can imagine, this is a very difficult proposition, right? It's just like predicting the stock market on a daily or even monthly basis. You could get lucky and time it right, or you could get it wrong and cost yourself a bunch of money. So as the saying goes, what goes up must come down. And it's most likely, the odds are in our favor, that we're close to the top of the Federal Reserve interest rate raising cycle. Though we don't know when it will happen, and we won't know until after it's happened that we've hit the top, because we'll see interest rates cut and then they'll get continually cut from there. But based on what the Federal Reserve has done, it would indicate that most likely we're towards the top of the interest rate cycle. So if you've ridden your bond fund all the way down, it might be prudent to ride it all the way back up. As I mentioned earlier, when interest rates are cut in the future, you will benefit by owning bond funds over money market. Now, money market funds will also begin paying less interest because money market rates reset every 7 days. And a lot of money market funds are paying 5%, maybe even a little bit more. So you're benefiting by being in a money market fund now because interest rates are higher, but as rates are cut, those money market funds will adjust lower, and the interest that they're paying will also go lower. One fund that I've talked about in past episodes, one money market fund, is if you use Charles Schwab or TD Ameritrade. This is one of the better ones that they have, SWVXX. It has a 7-day yield of 4.96%. So that's the interest that you're getting if you held this fund for an entire year. But again, that's resets every 7 days. So if rates go lower, the interest on that fund would go lower. And it also carries an annual expense ratio of 0.34%, which then reduces your yield. A comparable bond index fund, like the Schwab US Aggregate Bond Index Fund, is designed to track the Barclays Aggregate Index. And it has a 30-day yield, this is how bond funds are measured generally, of 4.27%. So that's actually a little bit less than the money market fund, but it does have a lower expense ratio of 0.04%. So you could be collecting more interest in the money market fund for the time being. But the question is that going to be the best move for you over the next 6 to 12 months or longer? So if you thought interest rates were going higher, you'd be better off in a money market fund, because any future interest rate increases will also push the price of any bond funds or bond index funds down, just like they did in 2022. But if you thought bond rates were going lower, interest rates were going lower, you'd be better off in a bond fund or a bond index fund. So because again, as rates are cut, the price of that fund would go up and you'd actually profit. The inverse would happen as far as what went on in 2022, where you lost money. But if you're not going to be following this and managing your allocation, your bond funds, you might be just better off in a bond fund, because you definitely need to track these interest rate changes and attempt to time the bond market to use either a bond index fund like SWAGX or some of the others that are out there. Or if you're going to be more actively traded, you could use a bond ETF fund like SPAB, which is a Spider Portfolio Aggregate Bond ETF. And bond markets move on a daily basis, as I mentioned, and the prices could go higher in anticipation of interest rate decreases in the future, even before the Federal Reserve lowers interest rates. So you could see the value of these funds actually go up or down based on future anticipated interest rates. However, it's still, as I mentioned before, a difficult task to trade bonds based off interest rate movements, and you could be better off by just leaving your money invested in the bond fund, or if you've been fortunate to be in a money market fund or a stable value fund, which is an option in some retirement plans similar to money market, and you've been fortunate to miss out on these decreases in bond prices based off the interest rate increases, then now could be a good time for you to potentially make that move into a bond fund or bond index fund to capitalize on these future interest rate decreases, which again will then push the price of your bond fund higher. Now, I say bond fund or bond index fund because that's a personal preference that you need to make, whether or not you're going to use an index-based strategy or you're going to use active management. So for more on bonds, you can check out other past episodes where I delve deeper into bonds. And as always, if you have a question that you'd like to have considered for a future episode, you can leave that question again by going to retirewithryan.com and recording your question. And I hope that this helps answer the question of whether or not you should sell your bond fund and go into money market. Have a great week, and I look forward to talking to you next Wednesday. Take care.